Hello, everyone, and welcome. We're jumping right into this explainer today to tackle the ultimate investing showdown. If you're new to investing in the US, you've absolutely hit this massive roadblock, the whole ETF versus mutual fund debate. Literally every new investor asks the exact same question: which one do I actually choose? Well, today, we're tearing down the jargon, we're looking straight at the facts, and by the end of this analysis, you're going to know exactly which option fits your wealth-building goals. Let's get right into it. Okay, so I want you to imagine a quick scenario with me. Picture two people. They're both super disciplined, and they each invest exactly $500 every single month. And they do this like clockwork for 20 years. One goes with an ETF, and the other goes with a mutual fund. Now, here's where it gets crazy. Both of these investors are actually putting their money into the exact same companies. I mean, their underlying investments are completely identical. But when they open up their accounts 2 decades later, one of them could end up with significantly more money. You're probably thinking, how is that even mathematically possible if they bought the same stuff? Well, picking the wrong investment vehicle can quietly drain your cash through hidden fees and totally unexpected taxes. So let's make sure that doesn't happen to you.
Section 1. Understanding the ETF basket.
To solve this missing money mystery, we first got to understand how these two actually work, starting with the ETF. At their core, both of these are really just ways to buy hundreds of companies all at once. It's a great way to lower your risk. But they operate so differently. So, what is an ETF? It stands for Exchange Traded Fund. Basically, think of it as a digital shopping basket of stocks. The absolute game changer here is that you can buy and sell it any time the stock market is open. You trade it throughout the day just like you would a single share of Apple or Tesla. If it's 11 a.m., you tap buy on your app and boom, it's yours at that exact second's price. But here's the magic. Unlike buying just one share of Apple, buying one share of an ETF means you instantly own a tiny slice of tons of companies. Like, a single ETF can hold shares of 500 different companies all at once. It's like a giant puzzle. If one piece, one company, has a terrible year, you've got 499 other companies right there to catch the fall. It is a fantastic defensive strategy for your portfolio.
Section 2. Understanding mutual funds. All right, let's pivot to our second contender in the $500 a month race, the mutual fund. Now, this is also a basket of investments, but here is the massive difference. You cannot buy or sell it throughout the day. Nope, it doesn't matter if you placed your order at 9:30 a.m. or 2 p.m. Every single trade for a mutual fund happens only after the market closes. And everyone, they all get the exact same final price for that day. It's a completely different rhythm of trading.
Plus, mutual funds are run by a fund company. And while some just follow the market automatically, a lot of them are actively managed by professional fund managers, meaning you're paying a team of humans to sit in an office, analyze the market, and try their hardest to pick winning investments to beat the average. Section 3. 5 crucial differences. So we've got the quick, flexible ETF on one hand and the end-of-day, professionally managed mutual fund on the other. Now let's really get into the weeds here. We're going to break down the 5 most crucial differences. Number 1 is trading. Like we just said, ETFs give you total intraday flexibility. Buy and sell whenever the market is open. Mutual funds, you buy or sell only at the end of the trading day. If the market is completely tanking at noon and you want out right then, well, a mutual fund makes you wait until the closing bell to see what price you're actually stuck with. Difference number 2 is fees. And honestly, pay attention because this one is massive. ETFs usually have way lower fees. Why? Because a lot of them just passively track a list of companies, like a top 500 index. It's automatic. Mutual funds, on the other hand, frequently charge much higher management fees. Remember those professional managers we talked about? Yeah, their salaries come directly out of your returns. So especially with actively managed funds, you're absolutely paying a premium. All right, difference number 3 is taxes. And if you're investing here in the US, you really need to hear this. ETFs are structured to be generally much more tax efficient. Mutual funds, though, they can pack a nasty surprise. They might distribute taxable capital gains to you even if you didn't sell a single share of your own investment. Literally, if the fund manager decides to sell stocks inside the fund, that tax bill can get passed right down to you. There's no way around it. Moving on to difference number 4, the minimum investment. ETFs are super accessible for beginners. You can often start with just the cost of a single share, or even fractional shares, depending on your broker. But some mutual funds, they can be pretty exclusive. They might demand a much higher minimum investment just to get in the door, sometimes thousands of dollars up front. Okay, let's do a rapid-fire recap so you can see the whole shebang. ETFs give you anytime trading, lower fees, high tax efficiency, and super low minimums. Mutual funds lock you into end-of-day trading, generally bring higher fees, carry the potential for unexpected taxable gains, and they might require a big chunk of cash to start.
Section 4. The real cost of fees. So let's bring it back to our two investors in their $500 a month. We have to talk about what those fees actually do in real life. It might just sound like a fraction of a percent difference on paper, right? Well, let's look at the steps again. Step 1, both invest $500 monthly. Step 2, they earn similar market returns over the years. But step 3 is the silent killer. They are paying drastically different annual fees. One gets the low, passive ETF fee, the other gets hit with that higher, active mutual fund fee. And here's the thing about 20 years. Those higher fees don't just take a little slice of the pie, they literally stop that money from compounding. It's an absolute game changer. Savings on fees compound over 20 years into a massive portfolio difference. Even if both accounts get the exact same market returns, the person with the lower fees keeps more of their own money. That saved money grows, and then that growth grows. It's a snowball effect. And that is exactly how our ETF investor could easily end up significantly richer.
Section 5. Which should you choose?
All right, the mystery of the missing money is officially solved. But now you're at a crossroads. Based on all of this, which one should you actually pick? Well, our sources break it down pretty clearly. You should definitely choose an ETF if you want lower costs. If keeping every penny of your returns is your top priority, go ETF. It's also your best bet if you want flexibility, trading on your own time. And of course, if you like passive investing and just want the broader market to do the heavy lifting for you. But hey, a mutual fund might actually be the right call for you in a few specific cases.
Choose a mutual fund if you genuinely want professional active management, like if you truly believe a human expert is going to beat the market average for you. Also, they're super common and really easy to use if you just want automatic, set-and-forget-it investing through a workplace retirement plan.
That being said, if you're looking for a solid baseline recommendation for a lot of beginners in the US, a low-cost ETF that tracks a broad market index is just a fantastic starting point. It's simple, it's effective, you get instant diversification, super low fees, and great tax efficiency right from day one. Of course, always check how this fits your specific goals and tax situation. But look, I want to leave you with the single most important takeaway from this entire explainer. ETFs, mutual funds, they are both proven tools. The absolutely crucial part isn't just agonizing over which one to pick. The real secret? It's starting early, investing consistently every single month, and staying in it for the long haul. Time and consistency are literally your biggest superpowers in the market. So the ball is in your court now. Are you going to let hidden fees quietly drain your portfolio? Or are you ready to take the wheel today? Based on your own goals, would you go with an ETF or a mutual fund? Let's get a debate going down in the comments. I really want to hear your strategies. And if this explainer helped clear things up for you, please drop a like and subscribe for more US finance content. Keep learning, keep investing, and I'll catch you in the next one.